The government is preparing to reprice gold and, yes, even buy Bitcoin. Now, I know that sounds crazy, but this isn't theory, all right? It's the quiet plan that's now moving through Washington that could rewrite the entire global monetary system. Now, most people think that the next monetary system, the next reset, is going to come from maybe the BRICS or from some new digital dollar. But what if it's actually coming from inside the US Treasury? Now, this is a plan that starts with gold, it ends with Bitcoin, and it changes how money itself works. Now, if this happens, the entire game flips overnight. Debt, inflation, even how assets are priced. And the people who see it early, they won't just protect their wealth, they'll multiply it. Now, I've been building and selling tech companies for decades. I'm a partner at a leading Bitcoin venture fund, and we're using this information in our strategies right now, today. So in this video, I'll break down exactly what's unfolding and how to position yourself before the reset hits. So let's go. All right, so it all starts with what looks like a boring tax bill. The kind that nobody really pays attention to, but hidden inside was a new 5% excise tax on remittances. Now, that's the money that basically people use to send abroad, right, to family members every single day. Now, the House Ways and Means Committee spelled it out very clearly. They said, quote, impose a 5% excise tax on remittance transfers collected by remittance providers. So in plain English, that means that anyone wiring dollars out of the US now pays a toll. They also floated something called Section 899. Now, this is a retaliatory tax designed to punish countries that target U.S. companies with digital or unfair taxes. Now, it didn't make it into the final version. The G7 pushed back on that. But the point wasn't whether it passed or not. The threat alone sent a very clear message, basically saying America's willing to tax global money flows to protect its financial dominance. So on the surface, this looks like a trade policy. Maybe it looks like a corporate taxation. But if you dig just one layer deeper, you start to see something much bigger forming underneath it. And while all this is going on, the BRICS countries, that's Brazil, Russia, India, China, South Africa, they've been quietly cutting the dollar out of trade. China and Russia, they now settle most of their bilateral trade in yuan or rubles. Brazil and China, they use yuan, and they used real for settlements. India, they've been buying Russian oil and rupees. What they're really doing is they're monetizing their supply chains. All right, think about that. Monetizing their supply chains. And they do this by using their own currencies to trade the real goods that they create, like energy and commodities. Now, that's a problem for the US because America doesn't have commodities. America doesn't really export as much stuff like the BRICS countries do anymore. So it can't monetize supply chains in the same way. Instead, the US is monetizing something different. The US is monetizing its payment chains. All right. These are the financial pipes that the world still relies on to move money around the world. Now, they can do this by taxing remittances, digital transactions, and even threatening penalties on foreign dollar holders. Now, the U.S. is turning the dollar system into a profit center itself. That's what I call the great squeeze. Now, it's not about defending the dollar. It's about charging rent to use it. To use the dollar, to use the dollar payment network. A 5% toll on money leaving the U.S., a new tax threat on countries holding U.S. debt, a higher beat tax on multinationals shifting profits abroad. Piece by piece, the U.S. is tightening the flow of capital, forcing dollars to stay home, and making foreign users pay for the privilege of using the U.S. dollar. And of course, that's just what we can see, right? That's the smoke, because behind the public plan is a second. It's a far more strategic move that almost nobody's talking about yet. It's a plan that starts with gold, but it ends with Bitcoin. And it could change the global financial system overnight. Okay, so that's the public plan, all right? That's the part they let us see. But behind it, there's another layer, a deeper layer. It's a 7-step sequence that looks a lot less like random policy and a lot more like strategy. All right, so let's start by walking through this step by step. So step number 1 is we want to scare gold onshore via tariff threats. Now, back in April 2025, the White House announced what they called a universal baseline tariff. It was 10% on every import into the United States. Now, they justified it as a trade reset, but what it really did was it reintroduced uncertainty across every supply chain. Now, when this happens, capital, commodities, they start to retreat back inside their fortress. All right, now we've seen this movie before. In 1933, President Roosevelt issued Executive Order 6102. He forced all private citizens to turn in their gold to the government. All right, that was followed by the Gold Reserve Act of 1934, which revalued gold from $20 an ounce to $35 an ounce, effectively devaluing the dollar overnight. Now, I'm not saying that's happening again, but the pattern is basically the same. When a country starts reshaping the trade regime and the debt system at the same time, it tightens control over its monetary base, and that starts with gold. Even America's allies have done it recently. Between 2013 and 2017, Germany's Bundesbank quietly repatriated about 600 tons of gold from New York and Paris back over to Frankfurt. They did that to ensure accessibility in a crisis. That's what they said, right? That's what they said. That's not what I'm saying. So yes, tariffs and gold don't sound connected at first, but history tells us a different story. When a government starts changing the rules, gold always comes home first. Okay, now step 2. Impose tax on foreign U.S. dollars and U.S. Treasury holdings. Now, the next move in the playbook was Section 899. This was buried deep in what the administration called the One Big Beautiful Bill. I've talked about this extensively on this channel. It was a retaliatory tax targeting what they described as, quote, unfair foreign taxes on U.S. companies. Now, I'm talking about things like digital services tax on the OECD's new global minimum tax rules. Now, here's why this matters. The language gave Washington the authority to impose reciprocal taxes on foreign entities that targeted U.S. firms. Or to put it another way, it's a threat to foreign counterparties connected to the U.S. dollar system. Now, it never went live, right? The G7 struck it down, but again, that's not the point. The point is the U.S. government just signaled to the entire world that it's willing to weaponize taxation against anyone holding dollar-linked assets, all right? That's the kind of message that you only need to send one time. Because once you've shown that you'll use that lever, the rest of the world starts moving before you ever pull it. All right, that's what I call a controlled demolition. You don't blow the system up, you just make it uncomfortable enough that capital starts to move where you want it to go. All right, now step 3, accelerate non-interest paying stablecoins offshore. All right, now step 3 connects the old system to the new one, to the new digital rails. Now, under current U.S. law, payment stablecoin issuers are prohibited from paying interest to holders. Circle's own terms say, they say it word for word, quote, USDC does not itself generate any interest or return for holders, end quote. And the SEC reinforced that earlier this year, saying covered stablecoins are, quote, issued for commercial use, not investment, end quote. All right, so what happens? Well, all the yield bearing, the risk tolerant liquidity, it moves offshore. That's why Tether, which is USDT, repositioned itself to El Salvador, the world's first Bitcoin legal tender nation. Now they control roughly about 60% of the global stablecoin market with a circulating supply of over $183 billion. Now, meanwhile, the U.S. regulated issuers like Circle, they can't compete because they can't share yield. Even the New York Department of Financial Services cracked down back in 2023. They ordered Paxos to stop minting BUSD, Binance's dollar token, effectively wiping it off the map. Now, by doing that, they sent a very loud signal to anyone still issuing inside the U.S., basically saying, play by our rules or get shut down. So what does all this mean in practice? It means the U.S. now has a tighter circle of controllable stablecoins inside its borders and a massive pool of non-interest paying dollar-denominated liquidity sitting offshore. Okay, that's the leverage. Because when you control the rules of the payment system, you control where the money flows and you control how fast. Now, each of these steps, they look separate at first when you look at the surface. But when you look deeper and you see together, they start to form the same picture. A controlled tightening of the system, tariffs at the border, taxes on the capital markets, and compliance pressures in the digital layer. It's all deliberate and it's all happening step by step, and it sets the stage for the next phase of the plan. Now, when gold gets repriced, the books get cleaned, and Bitcoin quietly becomes part of the balance sheet. Okay, so now that you've seen how the setup works, the tariffs, the tax breaks, the stablecoin structure, all tightening the rails of the system, but the real endgame, the thing that makes the entire strategy click, it all starts with gold, and let's get back to it, back to step 4. Now we let gold creep higher. Now, you've probably noticed Gold's been on an absolute tear this year. It quietly broke through $4,000 an ounce in October 2025. That's the first time in history it's ever been that high, right? It's already set over 40 new all-time highs just this year. It's up roughly about 50% year to date, and Reuters calls it the 45th new record of 2025. Now, that doesn't just happen in a vacuum. Right? The Fed's been cutting rates again, right? This October, the meeting, they brought the federal funds rate down to 3.75 to 4%. That's the second cut in a row. Now, lower rates, a weaker dollar, and record central bank demand, there's over 1,100 tons in 2024 alone for gold, right? All pushing this gold to levels that we've never seen before. So when we say step 4 is to let gold creep higher, that's not a conspiracy theory. That's literally what's happening. That's literally what's playing out right now. And it's the first visible step of the plan. All right, now step 5, remark gold to market price, and then flush the TGA with $1 trillion. All right, here's where things get really interesting. The United States officially holds over 8,000 tons of gold, about 281 million troy ounces. But on the books, the gold's still valued at only $42.22 per ounce. Now, that price was set back in 1973, and it hasn't changed since Nixon closed the gold window. But if you do the math, that means that the Treasury still lists its entire gold stockpile at around $11 billion. But at $4,000 an ounce, the market value of that same amount of gold is over $1 trillion. That's a $900 billion gap sitting right there on the balance sheet. Now, according to the Treasury's own accounting manual, the Treasury Financial Manual, when they issue gold certificates to the Federal Reserve, the value of those certificates is credited directly to the TGA, the Treasury General Account. Now, that's basically the government's checking account. It's where they pay the bills from. So if the Treasury were to remark that gold to market price, they could instantly inject roughly $1 trillion into that account. Without issuing a single new bond, without having to borrow a single penny, they'd simply be updating the value of the asset that they already own. This isn't without precedent. This has happened before. In 1934, Roosevelt, he did the same thing. After confiscating everyone's private gold through Executive Order 6102, he then signed the Gold Reserve Act, which revalued the gold from $20 to $35 an ounce. A 69% increase. Now, the difference in value back then was transferred into a new account called the Exchange Stabilization Fund. And that fund was then used to manage the currency and international reserves. All right, so we've seen this movie before. We've literally done it, right? They've done it before. They can do it again. And with gold at $4,000, the math is staring them right in the face. All right. Step number 6, covertly acquire Bitcoin for the strategic Bitcoin reserve. Now, here's where the new playbook, it starts to look very familiar, but this time with a 21st century twist. Now, in March of 2025, the White House signed an executive order to establish what they called a, quote, strategic crypto reserve. Now, it was reported to multiple outlets at the time, including Investopedia, Al Jazeera, and it specifically mentioned that it would be seeded with Bitcoin already in government custody. The same Bitcoin seized over the years from Silk Road and other cases. Then a few months later, in July of 25, Treasury Secretary Scott Bessent gave a speech at the White House titled, quote, Building the Golden Age of Crypto. Now, those were his words, not my words. He said that the goal was to align the next generation of monetary assets with American values of openness and innovation. And around the same time, Larry Fink, the CEO of BlackRock, said in a national interview, quote, there's a role for crypto the same way there's a role for gold, end quote. Now, put those dots together, right? The U.S. holds around 195,000 Bitcoin already through forfeitures. That's worth billions at current prices. If they decided to start buying quietly, even a few $100 million a month, nobody would even see it. It would look exactly like normal market flow. So if the gold gets remarked at the market price and the Treasury suddenly has $1 trillion in its new headroom in its general account, what better way to hedge that new liquidity than by converting part of it into the hardest digital asset on earth? Now, that's what the strategic Bitcoin reserve really is. It's a hedge against their own balance sheet expansion. All right, now let's go to step 7. Let hard assets run turbo. Now, once the balance sheet's been reset, once the strategic reserves are in place, there's really only one step left. You ease the policy, right? You let inflation run hot and you allow the assets that you just bought, gold, Bitcoin, and commodities, to reprice the system for you. That's exactly what's happening right now. After the October 29th rate cut, we saw gold hold above about $4,000. Bitcoin sitting close to near its all-time highs. Now, analysts over at Goldman Sachs, Bank of America, they've both raised their targets of gold of $4,500, maybe even $5,000 by next year. And as the dollar weakens and liquidity floods back in, we should see this run turbo. All right, run turbo, it's not just a theory. It's a description of what happens when you let the market do the repricing for you. Now, historically, that's how every debt-based system resets, through inflation and asset revaluation, not through austerity. Okay, so to recap, step 4, gold run. Step 5, remarket to market. Flush the Treasuries account with roughly $1 trillion in value. Step 6 was use that to quietly accumulate Bitcoin and other strategic assets. And then step 7 was, once the books are clean, drop the rates and let the markets run. Let the markets reprice them. Okay, that's the playbook. And when you zoom out, it all makes perfect sense. The system isn't being saved. The system's being reset. And the ones who understand how the pieces connect are the ones who are going to come out ahead on the other side of this. Okay, so now you see the pattern, right? The tariff, the tax levers, the gold revaluation, the Bitcoin reserve, right? It's all part of the same move. And the goal isn't to destroy the system, it's to rebuild it, but this time on a stronger base of hard assets. But the question that you should be asking is, who gets in position first? Who has the first mover advantage here? Treasury Secretary Scott Bessent said it plainly earlier this year. The United States needs to secure first mover advantage in this new financial system, end quote. That wasn't some kind of offhand comment, right? That was a policy directive he was telling us. When the executive order for the Strategic Crypto Reserve was signed back in March of 2025, it made the U.S. the first government in the world to officially recognize Bitcoin as a strategic monetary asset. That same language, first mover advantage, showed up again in the Treasury documents a few months later. And this is not just talk, right? The IMF's October 2025 Financial Stability Review said the same thing, that dollar-backed digital assets and tokenized treasuries could extend U.S. monetary dominance into the digital age, provided the U.S. acts first. So, the U.S. is moving early. They're building a reserve base of gold and Bitcoin before the next global shift hits full speed, because whoever controls the new settlement layer wins the next era of money. And now, look at what assets they're choosing, right? It's not stocks, it's not bonds, it's not real estate. It's gold, it's Bitcoin. The only two assets that sit outside the credit system. Gold's still the foundation of every major central bank reserve portfolio. Over 35,000 tons are held globally. But Bitcoin, as of this year, is officially being treated the same way by institutions. BlackRock iShares Bitcoin ETF filing describes Bitcoin as, quote, a reserve-grade digital asset, end quote. And they said it has characteristics similar to gold. The March 2025 executive order from the White House literally called it, quote, a strategic monetary asset for safeguarding U.S. financial stability in the digital era. Now, that's the key point here, right? They're telling you what they trust to store value through this transition. And those two assets, gold and Bitcoin, are the only ones that meet that. Now, while all this is happening on the reserve side, the government's also rewriting the rules of the payment system, right? Bessent said something that didn't make many headlines, but it's definitely worth remembering. He said, quote, the BRICS nations are monetizing their supply chains. The U.S. will monetize its payment chains, end quote. Now, we're seeing that play out already, right? The 5% remittance tax buried in the beautiful bill literally turns dollar payments into revenue streams. That means every international transaction, every movement of capital across borders is becoming a toll road. And the same thing's happening with stablecoins. Tether, now backed in El Salvador, processed over $15 trillion in payments this year. That's more than Visa. USDC has processed over $250 billion in domestic transfers. Even the IMF said that these tokenized dollars were the new euro dollar system. So in other words, the government's no longer just running the financial infrastructure. They're monetizing it. They're turning payment rails into profit centers. Now, if you're still operating entirely inside their system, then you're paying the toll every single time you move your money. This is where it all comes back to you, to me, right? It's our choice. We can opt out or be taxed, right? We can be inflated to zero. The U.S. national debt just passed $38 trillion. It's on track for $50 trillion by 2033, according to the CBO. Interest payments alone now exceed $1.1 trillion per year, making it the single largest budget expense, bigger than defense. Now, to keep it all afloat, the M2 money supply is back above $21 trillion. The dollar's purchasing power has dropped again, roughly about 46% just since the year 2000. So the government playbook's pretty simple. Inflate the debt away. You can either stay in that system where your money's taxed, inflated, monitored, or you can step outside it into assets that can't be printed, can't be seized. That's the choice. That's your choice. That's my choice. You're either a participant in that reset or you're a beneficiary of it. But the good news is you don't have to wait for permission to act like a sovereign nation, right? You can build your own version of a strategic reserve right now by holding the same assets that they are. Since 2020, gold's done really well. It's up about 172% since then. But Bitcoin remains the asymmetric bet on the next monetary system. Bitcoin's outperformed every major asset class. It's up roughly 1,450% in the same time frame. And you don't have to guess whether institutions believe it. BlackRock's Bitcoin ETF pulled in over $30 billion in assets within just 9 months. It's the fastest ETF inflow in history. Fidelity, Franklin Templeton, Van Eck, they're all directly holding Bitcoin for their clients. MicroStrategy has now more than 640,000 Bitcoin on its balance sheet. Metaplanet Japan's accepted Bitcoin as a treasury asset. Satsuma in the UK followed suit in 2025. They're all doing what governments are starting to do, building reserves in hard digital assets ahead of the next reset. Okay, so now when people hear all this, they think the system's collapsing. But that's not what's happening. We're not watching an end. We're watching a transition. You see, every major debt cycle ends this way. 1944 gave us Bretton Woods Agreement. 1971 gave us the dollar standard. 2025 is giving us the digital reserve era. Even the BIS, the central bank of all central banks, said it in 2025 in their annual report. They said, quote, tokenized reserves, gold, and digital bearer assets will coexist in a multi-asset reserve framework by 2030, end quote. This isn't about the end of money. It's about the end of their version of money. So the question isn't whether this reset's happening, because it's already underway. The question is, are you positioned to benefit from it? And more importantly, what does history show us? Well, time after time after time, what exactly happens when the price of gold doubles? If you want to know the answer to that, you should go watch that video right here, and I'll see you over there.